Why are you giving me a hard time? Okay, got to dig it out again. Chapter 8. Log in. But that's, we're there. We're getting there. Chapter 8. Okay, John?
I can see it.
All right, here we go. Receivables. Keep a mind fresh for this here. Accounts receivable is totally different than notes receivable. Is totally different than other receivables. Accounts receivable deals with your customers, those who buy and sell your product. Okay, who buy your product and pay you for it. Accounts receivable is with customers. Notes receivable, that's a formal written contract between you and the person you're loaning money to. That comes with interest. And non-trade would be anything else. I'm looking at something here they're calling loans to officers, advances to employees. Those are very typical other receivables.
One time in my career, they changed the paying method. Instead of paying 3 days late, they paid a week and a half late, and they advanced all the employees the difference so they wouldn't see a drop in their paycheck. I'm guessing that's the type of thing that they're talking about.
Not really. That's not really. No, what I'm talking about, John, is an employee comes up to the boss and says, "Boss, I can't pay my mortgage. I need $100. Do you think the company can give me $100?"
Oh, okay.
And the boss approves that, and then maybe they'll take that $100 out of your next paycheck. That's all we're talking about. Simple loans to employees.
Okay.
Yeah, I bet the people in that company were really mad when they changed the payroll period, huh?
Yeah, what they did is when they changed it, they basically, until I left the company, they carried at the very bottom of my pay stub money we advanced to you in making the change.
Yeah.
And then every once in a while, the accounting department would say, "Would you like to repay that back?" And I'm like, "No, I'll take the free interest."
That's very interesting. This company I worked for, I had to go to our South Carolina factory, and we had to go from a weekly payroll to twice a month. And those poor, no offense, but those poor Southern people down there, I thought they were going to have a heart attack when we put this through.
Yep.
Oh my God, how am I going to get to the next paycheck if I have to wait another, week? They figured it out. Yeah, this is all very repetitive here. Accounting for uncollectible accounts, okay? We really have three methods. Three. Direct method is not GAAP, no matching. You don't worry about a bad debt until you actually find out about it. That's not what any textbook would teach. We're teaching the allowance method, which is the proper way to do things, okay? Gives you good matching of revenues and expenses, and our receivables are always stated at what we believe to be the right net, and it's required by Mr. GAAP. Okay, now this could be a little tricky to understand, John. So let's go through it for a little bit of detail. We have what's called an allowance for doubtful accounts. That is a contra receivable account. It's married to accounts receivable. We are going to every month write a journal entry, an adjusting journal entry, where we debit bad debt expense and we credit this allowance. And this allowance is only usable to write off accounts receivable when we know who the bad guys are. So we take a look here. They're just showing you how it looks on the balance sheet. You have accounts receivable, less the allowance gives you net receivables. So they're just, that's not worth looking at here.
Are they trying to tell us here that when you record the accounts receivable, you, at that time, you're actually creating the allowance, or,
No, you're creating the allowance at the end of the month
okay,
based on a look at your aging of receivables.
okay,
In other words, you have an aging of 30-day brackets. If the customer is in the, say, the 0 to 30 range, your experience is you're only going to lose maybe 1% of that. When it gets older and older, it becomes less and less likely you're going to collect all of it. So
But-
you
but
come up with an estimated number.
each accounting period, you would make this judgment at month end, or?
Yes,
Okay, got
yes,
it.
yes, absolutely. Absolutely. So let's take a look here. Again, this is a lousy presentation. But we set up the allowance for $25. Okay. We had 25 to begin with, and then we put in another 15. Whenever you credit the allowance, everybody, the only thing you can possibly debit is bad debt expense. So we know that this was a debit to bad debt expense and a credit to the allowance, which gave us a balance of 40. Now, John, a month later, 2 months later, we find out who is not, definitely not going to pay us. You know, we've been trying to collect from this business down the street, and the guy finally threw up his hands and he says, "I'm so sorry. I'm never going to be able to make payment. I'm bankrupt." So at that point, we write him off. We write him off. Write off means we take them off accounts payable, accounts receivable, and we debit that allowance account. Okay. That's the flow. And it could be a little tricky. And I'm not too pleased with the way this book sets it up. Repetitive. Assume Warden writes off Duran's $200 balance. There is your, oh, that's the direct method. I'm not going to talk about that. The allowance method. Here we go, John. Let's listen to this now. Hampson has credit sales of $1.2 million, and 200,000 remain uncollected at the 31st. The credit manager estimates that 12,000 of these sales will prove uncollectible. You debit bad debt expense and you credit the allowance. Okay. When we write somebody off, now we're writing off Mr. Ware. Mr. Ware, we saw on television that he was arrested for fraud. He was caught on trying to get on a plane to Brazil. So we debit the allowance. In other words, we use the allowance and credit accounts receivable. The only time you debit the allowance is when you're crediting accounts receivable. So you have just 2 entries in this chapter. One, you debit bad debts expense, credit the allowance. The other one, you debit bad debt expense. I'm sorry, you debit the allowance and credit receivables. So look what happened here. Well, look at this. A couple months later, this guy actually paid us, John, after we wrote him off, huh? How about that? So now what we want to do is we want to put him back into accounts receivable. So we just reverse the entry. We debit accounts receivable, we put him back on the aging, and we can puff up our allowance by $500 in doing so. And then we record the cash payment. and the credit to receivables. Using the percentage of receivables method, which is the best way to do things. Here you go, John. This is an aging, right? We have total accounts receivable of 39,600. And most of it is in the not yet due column. And then it ages out 57, 3, 2, and 1, 9, 1900. Our best estimate is that if it's in the not yet due column, we're going to lose 2%. 1 to 3, we lose 4, 31 to 60, 10, all the way out to a whopping 40%. So what we're doing, class, is we're multiplying out each bracket, and then adding across, and we're coming up with a number 2228. That number 2228, though, is not the bad debt expense. That is the balance we want in the allowance account. So if there's a God in heaven, they explain that here. Okay. 2228 is the desired balance. So look what we have here. We had a balance of 528 at the end of the month. We want to go up to 2228. So our entry is a debit to bad debt expense for 1,700 and a credit to the allowance. You follow that, John? That's a little tricky.
Yeah, I see. So basically, you're almost carrying a running estimate of the allowance when you calculate the sum of the products and it's higher, you need to bump up your allowance to make sure that you're covering the risk.
Yes. Keep in mind that the number you get from here, 2228, is not the bad debt expense. I guarantee that mistakes could be made on the test. They might give you a look at an aging and say, come up with the bad debt expense, and everyone's gonna give you this number here. That's not the bad debt expense. That is what we want in the allowance at the end.
Got
Okay.
it. And since you had a head start with what it was when you entered the month, you just have to top it off.
Yeah, well said. Yeah, you had
Now,
the five.
if your math is lower, do you actually debit the allowance or do you just let it
Yes.
stay up?
Yes, no. If you feel that you really overestimated, yeah, you can take it back with with a debit to the allowance and a credit to bad debt expense. Yeah, that would be
Got
a
it.
correcting entry. Absolutely.
So what you really want is the balance at the very bottom to be the number that was on the sheet, not the adjustment to be.
Exactly right. Yeah.
Got it. Okay.
Yep. This company thinks that there'll be $2,228,000 worth of bad debts in the future. They just don't know who yet.
Got it.
When they know who, then they can write it off. And here they're showing you setting up the allowance amount here. You have a balance of 2728, and now they debited the allowance, which means they're going to credit accounts receivable. Bad debts are estimated to be 10% of receivables. And there's already a $2,000 debit balance. See, they try to trick you here, John. They're saying the balance in the allowance is now a debit. That's the very scenario you just asked about. Where if the month ended, we might have to go the other way. But here they're looking for $3,000. So you have a debit of 2 and a credit of 5. This is kind of interesting. Selling receivables to a factor. A factor could be a bank, could be an insurance company, could be anybody who takes this kind of gamble. We have $600,000 worth of receivable, and we want to collect them right now. We don't want to wait. So we go to federal factors, and the guy says, I'll take them off your hands for 2%. So he writes us a check for 588, and we have to debit cash for that. We debit service charge expense, and we get rid of all the accounts receivable. Now we have to keep collecting it, and what we collect goes directly to federal factors. You've heard of factors before, right, John? Factoring money?
Yes.
Yeah. Credit card sales are cash. Credit card sales are a contra sales account. contra sales account. When you buy something, like Anita Ferrari bought something here for $1,000 from us, she used a credit card. So we don't get that whole $1,000. We have to pay Visa $30. So the cash is only $970. Okay. And factoring, we just went over this. Notes receivable. Now, this is totally different than accounts payable. This is a borrowing situation. And a note, it may not look exactly like this, but this is a note. It'll always have an amount, a date. It'll have the time. It'll have the principal, the payer, the payee, and I guess most importantly, the interest rate. So here's a deal to borrow $1,000 at 12%. And we're borrowing this money on 2002, and it's just for 2 months. So this money has to be paid back at the end of June. And we got the maturity date. This is a good little note here because I always screwed this up, John. When counting the days to maturity, omit the date the note is issued, but include the due date. Okay.
Okay.
You don't count the date the note is issued, but you count everything up to the ending date. Notes receivable. Calhoun Company wrote a $1,000 200 promissory note to settle accounts receivable. So what happened here, John? We have a customer named Calhoun and they haven't been paying us. So finally Calhoun said to us, look, if you give me a year, give me 2 months, I can come up with $1,000 and I'm willing to sign a 12% note. So we say, okay, we have nothing to lose really. So we debit notes receivable, credit accounts receivable, and in 2 months, hopefully we get a check for 1,000 plus, I guess it would be $20 of interest if I did that right. Record, valuing notes receivable, disposing. Notes may be held to their maturity date. Maker may default, and we just got to put it back into accounts receivable. Or the holder speeds up the conversion to class, we can sell the note. A note is honored when it's paid. It's dishonored when it's not paid. Okay, so here they honored the note. This guy owed us $10,000 in receivables. We extended him some time to pay with a note, and it worked out good for everybody because he paid us $10,000 note receivable plus interest of $375. And notice the interest rate class. You see where it says 9% on the bottom? Whenever you see an interest rate, it always represents a year, 12 months. So you have to prorate it back down to the number of months that represents the note's life. We might need to accrue interest, huh? This guy owes us $300 as of the end of the year, but he's not going to pay us until January. Well, we earn that money at the end of the year. So in December, we can debit interest receivable and credit interest revenue. And now he honors the note. He pays the $10,375. The note goes down. Interest receivable was $375, and we had accrued $75 in interest. If it's dishonored, all you do is reverse the note back into accounts receivable plus the interest. And now he's back on receivable, and you're stuck where you were to begin with. You wasted another couple months with this guy. I don't know about this. They're saying use the allowance for doubtful accounts for notes receivable. Boy, I've never seen that before. Allowance for doubtful accounts, that's strictly trade receivables, I think. Recognizing notes receivable. Management, this stuff is not too. Okay. Okay, a couple of metrics, John. Accounts receivable turnover. Credits, it's the accounts receivable. I'm sorry, it's your credit sales divided by the accounts receivable average. You okay with that, John?
Yeah, and the credit sales would be the actual total, the sales you made, or is that just a subset of them?
As opposed to cash sales.
I got it. Okay.
That's all. When
Got
you get it, when you get into 240, you do a lot of cash budgeting, and they'll tell you the sales were 1,200,000 were cash, and that's an important thing to know, breaking it out.
Got it. Okay.
So you come up with a turnover of 9.9. You go into a meeting and say, wait, the turnover was 9.9. No one's gonna know what you're talking about. So you change it into days by dividing into a year. All right, I think that's the end of chapter 8, was it, right?
Yeah, and I think that's it for the test, because while you were going through that, I did a quick look, and it looks like test 3 is 9 and beyond. So I'm assuming, even though 9 started this week, that it's not on the test.
Yeah, I would have to come to the same thought, yeah.
Yeah, because the test 3 showed chapter 9 in it. Test 2 didn't list the chapters, so I just kind of did it by default.
Okay, sounds pretty good.
Okay. Well,
Are
thank
you
you.
gonna, are you gonna join me at 10:30?
Yeah. I guess. Yeah, probably. I'll join you.
Okay, we'll see you in a little bit, John. Thanks very much.
Bye.
Bye-bye.